Two people can live 4 blocks apart, earn almost identical salaries, and one of them will spend her entire life paying 30% more for everything: her car loan, her mortgage, her credit card, even her cell phone plan. The difference has nothing to do with her credit score. It has nothing to do with her payment history, her debt-to-income ratio, or any financial decision she has ever made. It has everything to do with her zip code, 5 digits assigned to a mail route, now functioning as the single most powerful pricing variable in the American financial system. That gap wasn't an accident. It wasn't the invisible hand of the market quietly sorting winners from losers. It was drawn, deliberately, on actual paper maps, by actual government officials, and the financial architecture they built in the 1930s is still quietly running underneath every loan offer, every insurance quote, and every mortgage rate you've ever been handed. The decisions made by federal employees nearly a century ago didn't just shape those neighborhoods. They priced them, and that pricing has never fully stopped. In 1933, the United States was financially collapsing. 1 in 4 Americans was unemployed, and the housing market had effectively frozen. Banks weren't lending because they had no standardized way to assess risk across the country's wildly different neighborhoods. So the federal government created the Home Owners Loan Corporation, the HOLC, and gave it a mission: map every residential neighborhood in every major American city and rate them for mortgage risk. Between 1935 and 1940, HOLC surveyors fanned out across 239 cities. They interviewed local real estate agents, bank officers, and developers. Then they drew maps. Each neighborhood got a color: green for the best investment, blue for still desirable, yellow for declining, and red meant hazardous. Do not lend here. Those red zones were the beginning of something that would metastasize for the next 90 years. And the single most consistent factor that pushed a neighborhood into the red: the racial composition of the people living there. A single black family moving into a previously green neighborhood was documented in HOLC survey notes as sufficient justification to drop its rating. That is not interpretation. That is what the surveyors wrote down. The HOLC maps didn't just describe risk, they manufactured it. When a neighborhood got a red rating, banks stopped issuing mortgages there. When mortgages stop, homeowners can't sell. When homeowners can't sell, property values stagnate. When property values stagnate, businesses leave. When businesses leave, the tax base erodes and city services shrink. Schools lose funding. Infrastructure goes unrepaired. The map had predicted the decline and then caused it. In 2020, researchers at the National Community Reinvestment Coalition cross-referenced the 1930s HOLC maps with current census data across 138 American cities. 74% of neighborhoods that were rated red in the 1930s are still low to moderate income today. 91% of neighborhoods rated green in the 1930s are still middle to upper income. The maps didn't just reflect the cities of 1938. They are, in measurable statistical terms, still describing the cities of right now. The feedback loop was so thorough, so structurally embedded, that it required no active maintenance to keep producing the same outcomes decade after decade. But the debt those maps created didn't stay locked inside the housing market. Here's where the system reveals itself. By the 1970s, the explicit racial language had been scrubbed from the process. Redlining was officially illegal under the 1968 Fair Housing Act, but the infrastructure that replaced it quietly reproduced the same outcomes. Banks began using zip codes as a primary variable in credit pricing models. Insurance companies built actuarial tables around geographic clusters. Auto lenders priced risk by address. Cell phone carriers and utility companies followed. In 2018, the National Fair Housing Alliance sent matched pairs of testers, same income, same credit score, different zip codes, to 17 major banks in 7 cities. Testers from zip codes that overlap with historically redlined areas were quoted interest rates up to 1.3 percentage points higher on identical loans. 1.3 points doesn't sound like much. On a 30-year, $200,000 mortgage, That single difference costs the borrower roughly $30,000 over the life of the loan. $30,000 paid not because of anything she did, not because of any risk she actually represents, but because of the 4 digits at the end of her address. But those digits didn't originate in a bank. They originated in a piece of infrastructure that most people have never thought about. The zip code itself was invented in 1963 by the United States Postal Service, not as a financial tool, but as a pure logistics solution. Robert Moon, a postal inspector from Philadelphia, had been advocating since 1944 for a national zone improvement plan. The first 3 digits of every zip code represent a sectional center facility, a mail sorting hub. The last two narrow it to a local delivery zone. Moon's system was designed entirely around truck routes and sorting efficiency. It had nothing to do with demographics, creditworthiness, or neighborhood investment potential. But within 5 years of the zip code's introduction, credit bureaus, insurers, and lenders had reverse-engineered it into a demographic proxy. Because mail routes follow roads, and roads in mid-century America had been deliberately built to reinforce the neighborhood segregation established by the HOLC maps, the zip code inherited the exact same geometry as the redlining maps, almost by accident. A logistics tool became a financial boundary marker, and that boundary marker became self-perpetuating in a way that the original cartographers never could have engineered on purpose. The Postal Service drew the lines to move the mail. The financial industry discovered that those lines were already pre-sorted by the federal government's own prior decisions and used them accordingly. Here is the number that recontextualizes everything. A 2021 study from the Brookings Institution calculated that owner-occupied homes in majority black neighborhoods across the United States are undervalued by a cumulative total of $156 billion, compared to identical homes in majority white neighborhoods. $156 billion of missing wealth. Not because those homes are structurally different, not because the land they sit on is worth less by any geological measure, not because the owners have maintained them less carefully, but because the financial systems pricing them were calibrated against maps drawn by federal employees between 1935 and 1940. Go back to those two people 4 blocks apart, same salary, same credit history, different zip codes. The one paying 30% more for her credit isn't paying a market rate. She's paying the residual cost of a color somebody put on a map before her parents were born. She has never seen that map. Her bank officer has probably never seen it either. Most of the algorithm developers pricing her zip code have never seen it. But its geometry is still running underneath her loan terms right now, translated into a zip code that a postal inspector invented to sort the mail. The system doesn't need anyone to maintain it. It maintains itself. Every time a lender prices a zip code, every time an insurer clusters a census tract, every time an algorithm sorts applicants by address, the map draws itself again. Follow one fact a day, no fluff. And here's a question worth sitting with. If lenders can price risk by zip code, can they be legally required to disclose when they're doing it exactly which zip codes are being penalized, by how much, and against what historical baseline? Because right now, in most cases, they are not.